complicated. The company recently executed a 1-4-10 reverse stock split, which is almost always a red flag for investors. Reverse splits are typically used as a last-ditch effort to keep a company compliant with minimum share price requirements for exchange listings rather than a sign of underlying business strength. Looking deeper, FOXO's financials are concerning. The company is burning cash, has negative earnings, and auditors have raised substantial doubt about its ability to continue as a going concern. Their recent moves into acquiring behavioral health clinics could be seen as a pivot, but it's unclear if this will be enough to reverse their fortunes. The stock's price action reflects this uncertainty. There's high volatility, low volume, and a persistent downward trend. Technical indicators and analyst sentiment are largely bearish, with most recommendations hovering between hold and sell. There's simply not enough evidence of a turnaround, and the risks far outweigh any speculative upside at this point. Unless you have a very high risk tolerance and a strong conviction in their new business strategy, FOXO is not a buy. Now, let's talk about MRIN software, ticker MRIN. This one is even more straightforward, but for all the wrong reasons. The company has announced a formal plan of dissolution and liquidation. This means they're planning to wind down all business operations, sell off their assets, and distribute whatever cash remains to shareholders. The board has already approved this plan, and it's pending shareholder approval. Once that happens, MRIN will be delisted from NASDAQ, and the company will cease to exist in its current form. What does this mean for investors? In situations like this, the only reason to buy is if you believe the liquidation value, the cash and assets distributed per share, will be higher than the current stock price. But this is highly speculative and depends on the company's ability to efficiently wind down operations and avoid unforeseen liabilities. There's also the risk that the process takes longer than expected or that the final payout is less than anticipated. For most investors, this is not a buy, it's a situation best left to distressed asset or special situations investors who specialize in liquidation scenarios. To sum it up, FOXO is a highly speculative turnaround story with significant red flags, and MRIN is in the process of dissolving itself entirely. Neither of these stocks fits the profile of a buy for anyone seeking stability, growth, or even a reasonable risk-reward trade-off. If you're looking for opportunities, there are far better places to put your capital, especially given your preference for positive earnings, strong fundamentals, and healthy balance sheets.